Today on the FinTalk channel, we're talking about Alphabet, Einz, Google. I mean, just imagine spending $91 billion on a factory before you even know exactly what the final product is going to look like.
Right. It's wild.
Yeah, but that is exactly what Alphabet did in 2025. So welcome to our deep dive into Alphabet's newly released Form 10K.
And, if you are holding this stock in your portfolio, or even if you're just trying to figure out where the whole digital economy is heading, this annual report is honestly the single most important document you can read right now.
Absolutely.
It's essentially the blueprint for the next decade of the internet. I mean, we are looking at a company that just generated $402.8 billion in revenue over the 2025 financial year, which ended December 31st.
Over $400 billion.
Yeah. But what's really buried in these filings is this massive, aggressive transformation. Alphabet is basically rewiring its entire architecture around artificial intelligence.
Right, from the ground up.
Exactly. So today, the mission is unpacking the sheer scale of the capital required to execute this pivot. Like how they actually plan to turn all that raw computing power into real profits for you, the investor. And of course, the massive regulatory crackdowns that are sort of threatening to derail the whole thing.
Okay, let's unpack this because to understand how a tech titan makes its money tomorrow, you really have to look at how it's spending its cash today.
Yeah, follow the money.
Always. You can't have a software revolution without laying down a massive physical hardware foundation first.
No, you can't. And the 10K reveals a capital expenditure figure that is, frankly, it's just hard to wrap your head around. It's $91.4 billion spent in a single year.
Wait, $91.4 billion just in CapEx?
Just in CapEx.
Yeah.
And the vast majority of that cash is being poured directly into technical infrastructure. We are talking about server farms the size of small towns, specialized network equipment, and just colossal data centers.
Which makes sense, given the AI push.
Right. Alphabet explicitly states in the report that they are taking a full-stack approach to AI. So they aren't just writing the software models like Gemini.
They're building the actual hardware.
Yes. They are designing the physical silicon those models run on. A really critical detail in the 10K is the aggressive deployment of their custom-built tensor processing units, the TPUs.
Ah, the TPUs.
Yeah, they are currently rolling out the 7th generation of these. It's codenamed Ironwood. Oh, well, they're still continuing to buy up specialized GPUs from the open market.
Let me just translate that for a second for anyone listening. If a standard computer chip, like a CPU, is basically a general contractor who can build any kind of house but works a bit slowly,
Sure, yeah.
then a specialized GPU is like a whole crew of workers building different rooms at the exact same time.
Yeah.
But what Alphabet is doing with these Ironwood TPUs is something else. They're building a highly specialized proprietary assembly line designed exclusively to stamp out AI models at hyperspeed. They are bypassing the standard hardware market entirely to build their own engine.
And, they are aggressively acquiring the ecosystem required to actually protect and power that proprietary engine, too.
Right, the acquisitions.
Yeah. The report details a definitive agreement to acquire the cloud security platform Wiz.
Oh, wow. For how much?
For $32 billion.
$32 billion. That is a massive deal.
It is. But think about it. If you are going to host the world's most advanced AI models and basically all this sensitive enterprise data, a single major security breach destroys your entire business premise.
Right. It's an existential risk.
Exactly. Wiz is their $32 billion moat. And on top of that, they bought data center and energy infrastructure provider Intersect for $4.8 billion.
Because of the power demands.
Right. You can build all the TPUs you want, but they require a staggering amount of electricity to run.
I mean, if I'm an institutional investor right now, I'm looking at this $91.4 billion capital expenditure, which, by the way, the report notes is expected to increase again in 2026.
Oh, yeah, it's going up.
And I'm sweating. I really am. It sounds like they are laying down the physical asphalt for a new global highway system before they even know exactly how many cars will actually drive on it.
That's a great analogy.
You are crushing your near-term free cash flow. So how does management justify this level of spending to its investors without sparking a complete shareholder revolt over shrinking margins?
What's fascinating here is that Alphabet's management is treating this not as a new product launch, but as an existential platform shift.
Like the move to mobile.
Exactly like mobile, or even the birth of the internet itself. Now, to address your point on margins, because it's a great point, the unit cost of computing power for generative AI is significantly higher than traditional search.
Because standard search is pretty cheap, right?
It's super cheap. When you type a query into a standard search engine, it's basically just retrieving indexed links from a database. Cheap, fast, highly optimized.
Right.
But when you ask a large language model to synthesize an original multi-paragraph response, that requires exponentially more compute power.
It has to actually think, so to speak.
So driving those data center efficiencies and creating that proprietary ironwood silicon, that is their mechanism for keeping those unit costs under control at a massive scale.
I see.
They're telling investors, in no uncertain terms, if we don't build this $91 billion factory right now, we simply won't have a business model in 5 years.
Oh, you have to build the factory before you can sell the product.
Exactly.
But a $91 billion factory can't just sit there humming in the dark. It has to generate cash.
Yeah.
So let's look at how Alphabet is actually converting those massive server farms into revenue for you, the investor.
The top line numbers are just staggering. Total 2025 revenue hit $402.8 billion. Yeah, that's a 15% year-over-year increase. And the absolute behemoth driving that revenue is Google Services. That segment alone brought in $342.7 billion.
And most of that is still search, right?
Yes. Google search alone accounts for $224.5 billion of that. And then YouTube ads brought in another $40.3 billion.
That's incredible.
But the most revealing metric in this entire 10K is that AI is no longer a separate division or, some experimental lab feature. It's the core engine.
Right, it's everywhere now.
Alphabet has 15 different products that each have over 500 million users, and 7 of those have over 2 billion users.
Like Maps, Gmail, Android.
Exactly. And every single one of them now runs on Gemini models.
And the 10K specifically highlights the rollout of Gemini 3, right?
It does. And we aren't just talking about a better chatbot here. The report focuses heavily on its multimodal understanding and its agentic capabilities.
Okay, let's break that jargon down for a second. Multimodal basically means the AI isn't just reading text anymore. It can watch a video, listen to an audio file, and analyze a spreadsheet all simultaneously to give you an answer.
Right. It understands context across format.
Exactly. And agentic means it's moving from being a passive assistant to an active agent. It doesn't just give you a recipe for dinner.
No, it interacts with your grocery delivery app to actually order the ingredients for you.
Yes. We're seeing this manifest in things like AI overviews and AI mode, which are fundamentally gutting the old 10 blue links experience of standard search.
And that same agentic power is what's driving their enterprise growth, too. Businesses aren't just buying ad space anymore. They are actively renting Alphabet's AI infrastructure.
Through Google Cloud.
Exactly. Google Cloud is actually the fastest growing segment in the entire company right now. It's up 36% to $58.7 billion.
36% growth at that scale is huge.
It's massive, and that growth is largely driven by companies utilizing Vertex AI and Gemini Enterprise to build their own internal tools.
Okay, but here's where it gets really interesting. Because there is a glaring built-in conflict in this entire strategy.
Oh, the cannibalization issue.
Yes.
Yeah.
For 2 decades, Alphabet made its billions through a very specific mechanism. You search for a plumber, they give you a list of results, and they mix in highly lucrative performance ads that you click on.
Right.
But if Gemini 3 gives you the exact, perfect answer immediately via an AI overview, maybe even booking the plumber for you, like we just talked about, you never click the ad.
You never even see it, potentially.
Exactly. Aren't they directly cannibalizing the very $224 billion search business that funded this whole AI pivot to begin with?
That is the single most critical vulnerability for Alphabet right now. And honestly, the 10K is surprisingly transparent about it.
Really? What do they say?
They explicitly state that new AI experiences may, and I quote here, monetize differently than historical offerings.
Monetize differently. That's corporate speak for we might make less money?
Pretty much. They know the traditional user journey is collapsing. However, they are attempting to balance this equation by deploying AI on the back end directly for the advertisers themselves.
Right.
They've introduced tools called Demand Gen and Performance Max.
Okay, so how do those actually work? Because to be honest, Performance Max just sounds like generic marketing fluff.
It does, but it's actually incredibly sophisticated. So instead of a business buying a specific keyword and just hoping you click it, Performance Max uses Alphabet's AI to ingest the advertiser's budget, their target audience, and their product.
Okay.
The AI then automatically generates thousands of variations of ads, and it tests them continuously across YouTube, standard search, Google Maps, and Gmail.
Wait, Thousands of variants automatically.
Automatically, it finds these untapped incremental conversion opportunities that a human marketer would just never spot.
I see.
So while the raw number of traditional search clicks might decrease because of those AI overviews, Alphabet is using AI to drastically increase the conversion rate of the ads that do get placed.
That makes sense. They are betting that if they deliver a higher return on investment for the advertiser, they can just charge more per conversion.
Exactly. Maintaining their revenue stream, even as the fundamental shape of the internet changes.
So they are using AI to optimize the ads that appear next to the AI-generated answers. It's a completely closed loop.
It's a very tight ecosystem.
But even with AI optimizing ad placements, Alphabet clearly knows the traditional search monopoly won't last forever. That $91 billion computing engine needs to solve physical world problems.
Right, getting out of the browser.
Exactly.
Oh.
Which leads us directly to why their other bets division is suddenly scaling up.
Yeah, the 10K makes a point of reminding investors of the original founders' letter. You remember the quote, "Google is not a conventional company. We do not intend to become one."
The famous mantra?
Right. And the other bets division is the financial manifestation of that philosophy. But man, it is an incredibly expensive philosophy.
How expensive?
Well, in 2025, other bets generated a mere $1.5 billion in revenue. But it operated at a massive loss of $7.5 billion.
See, I hear the unconventional company argument, but an unconventional philosophy shouldn't burn $7.5 billion of cash a year.
It's a steep price tag.
It's like having an internal venture capital firm where the massive failures are entirely subsidized by Google search. At what point does Wall Street look at this and say, the founders are just funding their pet science projects with shareholder money?
It's a valid critique.
Like, as an investor, when does this stop being a charming moonshot and start becoming a serious financial drag?
If we connect this to the bigger picture, you have to remember the history of this company. Today's core AI, the very technology driving their massive cloud growth, that was yesterday's moonshot.
That's fair.
Total research and development expenses hit $61 billion in 2025. Alphabet's strategy is to aggressively avoid incrementalism, those slow, safe, tiny updates that inevitably lead to a tech company's irrelevance.
Right. It's the classic innovator's dilemma. If you don't disrupt yourself, someone else will definitely do it for you.
Exactly. And we are seeing that disruption materialize into actual businesses now. Just look at Waymo.
Waymo is fascinating right now.
They aren't just test vehicles with safety drivers anymore. Waymo is providing fully autonomous, paid ride-hailing services to regular customers in multiple major cities.
What? You can just hail one on your phone.
And the financial filings show real proof of this scale. In the fourth quarter of 2025, Alphabet recognized a $2.1 billion employee compensation charge specifically for Waymo.
Okay, let's clarify why a compensation charge is actually a positive signal here.
Yeah, it sounds bad at first.
Right, but that means Waymo's internal stock valuation spiked so high based on its performance and expansion that the equity they owe their employees jumped by $2 billion.
Exactly the mechanism at play. It's a sign of massive value creation. Furthermore, in February 2026, Waymo announced a $16 billion investment round.
$16 billion.
Yeah. And while some outside capital was involved, the vast majority was funded by Alphabet itself. They are doubling down.
They really are.
You also see this in ventures like Isomorphic Labs, which is using AI to completely reimagine drug discovery.
Moving away from the whole trial and error chemistry model.
Right. Instead of decades-long lab tests, they are using AI to predict protein folding and design drugs from first principles. So yes, a $7.5 billion operating loss is a massive pill for investors to swallow.
Pun intended.
Right. But management views it as an existential insurance policy. They're essentially paying for the right to own the next major paradigm shift.
But, you can't reach that kind of size, dominating the digital search space, expanding into enterprise cloud, and putting autonomous cars on physical roads without painting a massive target on your back.
Oh, definitely.
Which brings us to the biggest immediate risk facing the company, and really anyone holding its stock: global regulatory crackdowns and internal governance.
Alphabet is currently navigating an incredibly dense web of global antitrust actions. The 10K outlines significant enforcement, particularly from the European Commission.
The EC does not mess around.
No, they have been relentless. They levied a €2.4 billion fine for how Google ranked shopping search results, which Alphabet finally paid in 2024.
Ouch.
And then, in September 2025, the EC hit them with a new €3.0 billion fine for alleged self-preferencing practices within their advertising technology business.
Hold on, let's break down self-preferencing for a second, because it sounds like a victimless corporate buzzword, but it's actually the core of the whole monopoly argument.
It absolutely is.
How does that mechanism actually work? Are regulators arguing that Alphabet uses its dominance in search to push its own tools like Google Flights or Google Shopping above a competitor's organic link, even if the competitor has a better or cheaper product?
That is the exact mechanism. Regulators are essentially arguing that Alphabet owns the highway, they own the billboards along the highway, and they own the destination store.
I see.
The EC claims Alphabet leverages its dominance at every single level of the ad tech stack to advantage its own services, basically squeezing out independent publishers and rival ad networks.
And it isn't just Europe taking issue with this anymore. Things are hitting a real boiling point domestically in the United States.
Very much so.
The SEC filings detail a major lawsuit from the U.S. Department of Justice and several state attorneys general targeting Google's search and advertising practices. And in August 2024, the DOJ won a major ruling.
A huge ruling.
Right. A final judgment was entered in December 2025, and the proposed remedies are severe. I mean, they include forcing Google to share its proprietary search data and offer syndication services directly to competitors.
And Alphabet is, of course, vigorously defending its position here. They filed an appeal to that final judgment in January 2026, attempting to pause the implementation of those remedies.
Didn't the DOJ appeal as well?
Yes, the DOJ and the state attorneys general actually filed their own cross appeals in February 2026, pushing for even stricter structural breakups. Now, as objective analysts of this 10K, we aren't taking a side on whether the DOJ or Alphabet is politically or legally right here. We're just looking at the facts. But the sheer volume of these legal battles makes it very clear that the regulatory environment is one of the most substantial financial headwinds the company faces.
Absolutely. And here is the absolute kicker for you, the retail investor, looking at all of this. Despite these massive regulatory risks, the multi-billion-dollar fines, and those $91 billion CapEx bets we talked about, you have almost zero power to change the company's direction.
None.
The 10K clearly outlines Alphabet's multi-class stock structure. Larry Page and Sergey Brin, the founders, own about 89.3% of the Class B stock.
And Class B has the voting power.
Right. Because Class B stock carries 10 votes per share, that gives Larry and Sergey 52.7% of the total voting power of the entire company.
They hold the cards.
Meanwhile, the Class A stock you buy in the open market has 1 vote, and the Class C stock has literally 0 votes.
Yeah, it's wild.
It's essentially like sitting in the passenger seat of a Waymo car, where Larry and Sergey are the only ones holding a steering wheel. Does this concentrated control protect the company from short-term Wall Street demands? Or does it leave retail investors entirely helpless if the founders make a strategic misstep with this massive AI pivot?
This raises an important question, and honestly, it is the central tension of Alphabet's corporate governance.
How so?
Well, on one hand, this insulated structure is the only reason they can push through these massive long-term visions. When management decides to spend $91 billion on data centers, or absorb a $7.5 billion loss on isomorphic labs and Waymo,
Wall Street usually hates that.
notoriously hates unpredictable long-term R&D spending. They want quarterly profit links. But because of this structure, Larry and Sergey can do it without fear of activist investors launching a hostile takeover. Their voting bloc allows them to ignore Wall Street and play a 10-year game.
But the flip side is a total lack of accountability.
Precisely the risk. Shareholders just have to accept the ride. If the Gemini investments fail to yield returns, or if the regulatory fines from their dominant market strategies compound into the tens of billions, the retail investor has absolutely no mechanism to vote the current leadership out or force a change in strategy.
Yeah, none at all.
If you buy this stock, you are making an absolute foundational bet on the continued competence and vision of the founders and their chosen CEO, Sundar Pichai.
It is the ultimate exercise in investor trust.
It really is.
Okay, let's summarize what we've unpacked today. Alphabet is a $402.8 billion revenue titan that is currently betting its entire future on AI.
Completely.
They are pouring tens of billions into technical infrastructure, custom ironwood silicon, and massive acquisitions like Wiz. They are racing to balance the potential cannibalization of their legacy search business by creating new AI advertising tools like Performance Max.
All while subsidizing billion-dollar moonshots in autonomous driving and medicine.
Exactly. And they are executing this incredibly complex high-wire act while navigating intense global antitrust scrutiny and operating under the absolute unchecked voting control of its founders.
It's a lot.
It's a lot. So what does this all mean?
Well, I want to leave you with a final detail from the source material to ponder. And it shifts our perspective entirely from the digital realm to physical resources.
Oh, interesting.
Yeah. We spent this whole deep dive talking about software, code, and silicon, but what actually powers all of that, buried in the very last pages of the 10K, it notes that in January 2026, Alphabet executed a massive power purchase agreement.
Power purchase, so electricity.
Electricity. This agreement is expected to cost $9.9 billion between 2027 and 2047.
Wow, almost $10 billion just for power.
And the contract stipulates that if certain conditions aren't met, Alphabet will just step in and buy the power-generating assets outright for $3.5 billion.
They'll just buy the power plant.
They'll just buy it. It leaves you wondering, as this artificial intelligence arms race continues to accelerate, will the ultimate winner be decided by who writes the best code, or simply by who controls the most electricity on the physical grid?
That is an incredible thought to end on. You can build the most advanced digital highway in the history of the world, but if you don't own the power lines to keep the lights on, the cars aren't going anywhere.
Exactly.
Well, thank you so much for joining us on the FinTalk channel for this deep dive. If you're holding Alphabet or just watching the tech space evolve, keep learning, keep questioning the numbers, and stay curious. We'll see you next time.